Good day, guys. Welcome to Smart Money Concept Trading by WikiFX. So, I'll be your host. I'm going to be breaking down smart money concept into a very simplified manner that we can use for our trading. So, it does not have to be complicated as far as you know what to do. You know when to enter and when to exit. It's not a course, it does not need to be too complicated. So I'll try to make it as simple as I can. So first of all, what is smart money concept? Smart money. Now, majority of the focus of smart money concept is focusing on how the institutions trade, how the hedge funds, how banks trade. Now, we know in the forex market, a large part of the forex market, what makes up the liquidity of a large part of the forex market is not us retail traders. We're just like a pinch of salt in the whole soup. So it's not really us that make the liquidity in smart money concepts. It's just like you have Dangote producing Smith, and then you yourself you just go and say, "Oh, let me make small Smith." You carry your limestone and mix, and then you want to sell your Smith. You are not a large participant in that market. So the best thing for you to do is to follow the footsteps of those that are in the large participants. And there are companies, financial companies, their job, the way they make money is by trading in the forex market. People that hold large funds of money, for example, pension funds, for example, banks, they don't just make profit by giving out loans. They also make profit by trading in the forex market. Hedge funds, people that will just control large amounts of money from investors, will collect large amounts of money from investors, and then they'll use to trade and they'll be making small return. And at the end, give those investors profit on their capital. So you can search up hedge funds, you'll find JP Morgan and many others, Goldman Sachs and many other hedge funds. So they are the large participants in the forex market. So if they are carrying price from one level to another, it will be wrong for you to now be trading against them. You will just get liquidated. What it means is that your money is going to be transferred from your pocket to their pocket. Because we know what makes up liquidity in the forex market is people's money. People are staking money. There is money. People, let me use the word betting. Betting that, oh, this country's economy is going to rise against this other. So the what invest in this economy against the other economy. And then when this economy actually rises in their favor, their investment increase, right? But if they invested in the wrong economy, when the economy fails, their investments also decrease. So that's really how forex markets work. Anytime you lose money, just know that it has entered another person's pocket. And anytime you gain money, just know you collected money from someone else's pocket. Because the money in the forex market is not from heaven. It's the people that are putting their money inside that's making its liquidity. That's making the liquidity in the market. So that is smart money for you. That's what we mean by smart money. Now, smart money concept trading, abbreviated as SMC trading, is a type of trading that focuses on this theory. I call them the pillars of smart money concept because this is all you really need as a smart money concept trader. The first thing you should be able to understand market structure. If you can understand market structure, you'll be able to gauge or you're able to know the direction that price is heading, right? And then to inform you to make decisions whether you are buying or you are selling. Now, trading is different from gambling because gambling you guess or you take picks and it's either you win or you lose. But in trading, it is either if you're a disciplined trader, it's either you lose small, or win big. If you are losing big, then it means you are gambling. So when you are able to judge market structure, instead of guessing, oh, I think market is going to go in the upwards direction, let me buy. Or I think market is going to sell. You just look at something and say, I think market is going to sell. Don't act on your thinking. Stop trying to predict the future. Wait for the future to happen, then enter. Eh? Why are you trying to guess if price is going to go up? Why not just see that, oh, price is going up, and then ride with price? So that is really how smart money concepts work. So we have supply and demand. Yes, it is a mixture of supply and demand trading while understanding liquidity and also understanding manipulation by these large institutions. Now, supply and demand is a form of trading, but it's under smart money concept. Now, supply simply means where the market is likely to sell from, where the market is likely to sell from. Just as in economies where you have demand and supply, so also you have in the forex market. That is the region where people are more likely to enter the market, either selling, which is for supply, right? So maybe after price has overbought for a certain period of time, after price have overbought for a certain period of time, a region is always created, and that region is the next region where price might likely what sell. But also knows that price can never be too high or too low. So you cannot say, oh, this price is too high, so it will sell. No, it can go higher. But just know that there are some regions where it is likely, which means there's a higher probability that it will sell. And then you watch out for the reactions at this region. And when you see a valid confirmation before you enter, you don't just jump in. Now, demand is the region where people are more likely to buy. It's the region where people are placing their orders to buy from. Remember, the forex market is more like a big house or a big game of people trying to make profit from other people. Let me give you this illustration. For example, we have the naira and the dollar, right? Let's say we have one group, or let's say we have, yes, we have one group that have naira in their possession, right? And let's say we have another group that have dollar in their possession. Now let's say $1 is equals to one naira, and then these people have 10 naira, these people have what, $10. Now, when there is inequality in supply and demand, or if the value of one currency increase, what does that mean? The value of the other currency will decrease because they are related in supply and demand. If I'm demanding for dollar, it means what? I am supplying naira, or I don't want naira anymore. I need dollar, and because I need dollar, I will not tell you you have to give me twice of your naira if you want me to give you my dollar. So instead of me having 10 naira and you having $10, because demand for dollar has gone up, you will be able to get twice of my 10 naira. So you'll be able to get twice the value of my money for just one of the value of his money. For example, now since I need this dollar, and I say I'll give you $1, but you're going to give me 2 naira. Now what does that mean? It means what now? Dollar and naira are no longer equal. And that means if I have 10 naira now, it's just like having $5. While him, if he has $10 now, it's like having what, $20. Now if you look at it, somebody lose and somebody gained. The person with the dollar gained extra 10 naira because value of the dollar increased times 2. While the person with the naira lost half of his own money because the value of the what naira decreased, right? You see this happening every day. You just hear to see, oh, dollar has increased, dollar has increased. what you were buying for 200 naira before, you now have to buy it for 400, and it's the same thing. So what that extra 200 that you're spending on it now, where is it going to? It's going to the pocket of those with the dollar, right? Because them now, what they were able to buy with $1 before, they'll not be able to buy it with what? $0.5. So that is just how smart money concept work. Sorry, how supply and demand work. So you should be able to spot supply and demand areas, and then you should be able to identify market structure. And then the most important part, when you know supply and demand, when you know market structure, liquidity and manipulation is the most vital part, because it is only when you can actually spot liquidity and manipulation that you can have good entries, good refined entries. Now, for example, let's say we all know that what market is going to buy from this zone, right? We have like a supply zone here. So the market is going to sell from that zone, and market is going to buy from this zone, right? Now, what liquidity and manipulation entails is that since these big institutions and what smart money smart money, we call them smart money, know that, oh, people think this region is too cheap for price, and that price is going to what? Buy. People have started buying the currency because they think it's going to start gaining value, right? What are we going to do? We're going to dump it to pump money inside the currency, or they will sell more, making it more cheaper. So those that were intending to buy, them buying will make them lose value because they are buying a currency that is still becoming cheaper or is still going lower. I don't know if you get, because when we buy, we know that a currency is going to rise, and when we sell, we know that a currency is going to what? Is going to lose value or is going to fall. So most people would have placed their orders here. Let's say they see a little pattern like this. Most people will place their buy orders and here, right? And then they'll put their stop loss a little below the previous low, and then they'll put their take profit at this level. And then you see that price, wow, it will go their direction, and oh, price is going my direction. Then before you know, it will come back and hit their stop loss. Wow, and as it hits their stop loss, breakout traders, people that think once price breaks a region, that means it's going to keep going lower, right? Then they'll try to enter again. They'll say, oh, that means price is going to sell. This price is going to still become cheaper. Then they'll place a sell here. Maybe they'll wait for a retest, and then they'll place a sell here, right? And then they might put their stop loss a little below this high, and then you see that price will go up, hit their stop loss, and go in the initial direction to that zone, and then they have stopped that twice. So if their risk to reward was 1 to 3, let me go check. Their risk to reward was 1 to 3. They already be stopped that twice, right? Which means if they win their next trade, they will just have few profits. If they lose their net, okay, let me not jump to that. But what this means is that they have lost twice, right? So they might never have the strength to enter a trade again because they are now confused, and they have eaten most of their capital for the day. Their risks for the day has already been collected. So this is what happened. Now, what smart money traders try to look at for is that, oh, we have these obvious lows that price honestly is supposed to react from, right? So smart money concept traders will not enter early. Instead, they'll wait for the liquidity sweep. They'll wait for that zone to be swept. Because they know it will always be swept. It's always be swept. It will always be swept. So they'll wait for that area to always be swept. And then once they see that sweep, what would they do now? They'll wait for a change of character. You don't need to enter early. You don't need to rush. Price will always still retrace, so you can enter. Then they'll wait for what? A retracement, because price will not always go up once. In a smaller time frame, price there will always be retracement, retracement, retracement. After they see liquidity sweep, then they'll wait for price to break this previous high that was formed. This will be their change of character. Okay, I used the wrong one there. I'll explain all these things. So I just want to explain the whole concept of smart money. It will be their change of character. And after they see that, they'll wait for what? Price to retrace. Price will retrace a little into either a fair value gap or another block. Then that's where they'll place their orders. That's where they'll place their orders. And then you see their risk is smaller. Why is their risk smaller? Because they have waited for a retracement. Instead of this retracement happening in the area of their stop loss, they just waited for it and entered. So you see, you'll put your stop loss a little before the sweep, a little above the liquidity sweep. Because you know liquidity has already been swept and it might not come down lower than that. And then you see their stop loss is very small and their risk to reward is high. And then you see price start what's going in their direction. Now, one thing I love about smart money concept, because even if you're not right about the direction, as long as you enter after the retracement, price will surely move up in your direction a little, at least for it to break even before price comes back down again. So in a way, your entry is always quite safe. You can see most times, even when we're stopped out of the market or when we broke even in the group chat, see that price always went in our direction. This is because we always enter after the retracement, so we know our market structure or how the price moves. So, and another thing about smart money concept is that their risk to reward ratio is always what? High. So that is it. So that is all for smart money concept. Right? So this is liquidity and what? Manipulation. So I've explained liquidity. Let me explain manipulation. So manipulation occurs before liquidity sweep. Now, this right here, where we saw what? A low here, and a low here is what we call manipulation. Although it's a theory that people actually do this manipulation, but what I think is that the market plays it out itself, and the smart money concept use this opportunity to take out what the buyers and the sellers, both of them, to take their money. They need liquidity to feed their orders. When smart money concept want to feed orders, they need large liquidity. They need money of people to feed their orders. You understand? To appease their investors, they need profits. So collect your money, even if it is by.
Put my entries where the masses put their stops. Most people will put their stops at very predictable places. If you're an institutional trader, your job is to generate the liquidity to get into the position. You just can't press the button like us. So invariably, the market makers will not know where the stops are, or they couldn't be bothered to find out. But they know that most people will put their stop a tick or two below the last low. And invariably, the market will go to where the obvious stops are over and over and over again. So rule number 3 is I want to put my entries at the obvious stops.
Yeah, there is manipulation for you. So since they saw these things, it is the job of institutional traders to what? Generate liquidity. That is one of their strategies. And by doing this, they will push price a little tick, some ticks lower. They will bid price very low, just to clear out the obvious stops of these people before pushing price up. That's why I always hear this saying, your stop loss is my entry. Where people's stop loss are is where people they enter the market. So if you can always enter the market where your stop loss is, you discover that yes, you actually right about the direction, but were you able to enter? Were you right about your entry? Did you enter too early? Did you enter too late? Or the price hit your stop loss 5 times before it moved in your direction? That is all about smart money concept. So, like I said, it's about what supply and demand, liquidity and manipulation, and market structure. Market structure is basically how price moves. What you need to understand if price is in an uptrend, if price is in a downtrend. So these are the pillars for me in smart money concept. And once you understand these three things and you practice very well, you'll be able to take good trades, right? All trades might not be winning trades, but the ones that win, you will catch a lot. You have a high reward because your reward is always higher than your risk. So even if you lose, let's say out of 10 trades, you lose 7. If your risk to reward is 1 to 7, if out of 10 trades you lose 7 and you only win 3, then your net profit for that day, you're already in profit. I'll explain those in advanced risk management, but I hope I'll be able to at least grasp the concept of smart money, right? This is the concept of smart money. Explain it in the simplest way possible. So there's no need to complicate things. Good is to make money. Thank you. So I hope you reach the end and that you can play this video back again to try to understand the concept. You have to try to be able to picture it in your head so that you understand what's happening. So just try to understand how the markets move, who the market players are, and what our role is as SMC traders. Thank you very much for your time.